welcome back to another episode of MC Explains, an investor education initiative by Moneycontrol and Risko Mutual Fund. And today we are going to decode the PRC Matrix for debt funds. Have you ever heard of the PRC Matrix that market regulator SEBI has put in place? You may have seen it printed on debt fund fact sheets or fund brochures released by mutual funds at the end of every month. If you are a debt fund investor and have never heard of the PRC Matrix or seen what it looks like, then this video will tell you why you must and how it can help. Now, before the PRC Matrix came into existence, SEBI had mandated the use of something called the Risko Meter, which shows the current level of risk in a fund. The scheme Risko Meter has 6 levels of risk and as I said, it shows the current level of risk. The PRC Matrix, on the other hand, shows the maximum level of risk a fund can take. In June 2021, SEBI notified asset managers about the potential risk class or PRC Matrix for debt schemes based on interest rate risk and credit risk. Interest rate risk in debt funds is measured by a metric known as Macaulay duration, which is published for each debt fund scheme in the monthly fact sheet. Now, bond prices rise when interest rates fall and prices fall when interest rates rise. Macaulay duration measures this price sensitivity of a debt fund scheme given its portfolio yield and average time to maturity, and it is expressed as number of days or years. The higher the Macaulay duration, higher the interest rate risk the fund has taken. And so any small rise in interest rates can trigger a large fall in bond prices if the Macaulay duration is high, resulting in a drop in the net asset value or daily price of your debt fund. In the PRC Matrix, there are 3 levels of interest rate risk that have been outlined. For a debt fund scheme, the maximum weighted interest rate risk is considered since it's a portfolio of securities. Now, Class 1 is the relatively low interest rate risk and applies to funds with a Macaulay duration of less than 1 year. Class 2 is moderate interest rate risk and applies to funds with a Macaulay duration of less than or equal to 3 years. Class 3 is relatively high interest rate risk and applies to funds with a Macaulay duration which is higher than 3 years. So that's the one to watch out for. Credit risk, on the other hand, measures the quality of the portfolio a debt fund holds. Every bond or security in a debt fund will have a credit rating. If the bond is issued by the government, state or central, it is considered as a sovereign guarantee and of the highest credit quality. All other bonds, the credit rating moves from AAA, which denotes the highest quality of bonds, to below investment grade, and all such debt securities are assigned a value for credit risk. Just as in case of interest rate risk, for credit risk too, SEBI has outlined 3 levels in the PRC Matrix. As mentioned earlier, government bonds are the highest level of safety at number 13, followed by AAA rated bonds, which are at number 12. For a scheme portfolio, the weighted credit risk is considered. Now, Class A schemes are those where the credit risk value is greater than or equal to 12. These funds only invest in government securities and AAA rated bonds. Class B schemes are those where the credit risk value is greater than or equal to 10, which includes AA and AA plus rated bonds, along with bonds which fall in Class A. Class C schemes are those where the credit risk value is less than 10 but up to investment grade, as mutual funds in India are not allowed to invest below investment grade securities. So this is the one with highest risk. The matrix itself is a 3 by 3 structure with 3 columns devoted to the 3 levels of credit rating, beginning with the highest rating level in the leftmost column, and the 3 rows are devoted to the 3 levels of interest rate risk, beginning with the lowest level of risk in the topmost row. For example, if the scheme you are invested in or are interested to invest in is highlighted in the middle box of the 3 by 3 PRC matrix, it means that the PRC score is B2. In other words, The scheme can invest in bonds with second level of credit risk value. Hence, the portfolio can include like government bonds, AAA rated, AA, AA plus bonds. It also shows that the interest rate risk in the scheme can go up to 3 years. This is a moderate risk product. It is important to know the maximum level of risk a scheme can take in the debt fund category, because a low risk debt fund can be used to build something as sacred as your emergency pool. Now, just knowing that the current position is low or lowest risk on the Risko Meter is not sufficient. You need to be sure that this is currently low risk fund will not be tempted to notch up interest rate risk or credit risk at other times as well. For example, it may not help you to invest money kept aside for medical emergencies in a fund which falls in the middle box in the PRC Matrix, even if the Risko Meter shows that the current level of risk is at the lowest level. You do not know when this emergency can show up, and hence you want an investment where the risk level is always the lowest possible, no matter what the market conditions are. The PRC Matrix is a great indicator for investors to understand whether the debt fund they are choosing is the most relevant for the goal intended at all points in time. It is a definitive guide to the precise risk intention of a debt fund. Basis this matrix, you can compare two debt funds within the same category to see the finer difference in how much risk a fund can take. Moreover, the PRC matrix is a checkpoint of sorts for asset managers too. The position of a fund as per the PRC matrix has to be included in the scheme information document as part of fundamental attributes of the scheme. Any deviation leading to exceeding the limits, if the deviations persist, it calls for a change in fundamental attributes of the fund and requires the AMC to then notify investors, giving them an option to exit the scheme upon this change. The PRC matrix may seem a tad complicated, but it is a critical risk guide for investors in selecting debt funds, and it's worth spending time on understanding how to interpret this small 3x3 box.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.